Yes, we are live now.
Okay. So a very good morning to all of you. I'm sure and hope you all are safe with your family. My sincere wishes to keep you uh, all to be safe in this pandemic. And today is the fifth day of our program or the refresher course. And the topic of today's discussion is post-pandemic challenges and opportunities of monetary policy strategy in India. So, with the previous sessions, I'm very much sure that you all are gaining and enjoying the sessions. For today, we have a very special guest who is a well-known personality for academic and financial world. In addition, I would like to introduce you all to Mr. Abhik Barua sir, who is a chief economist and executive vice president of SDFC Bank and has been in the financial sector for 27 years now. He has been earlier been with the Chrysler, Standard & Poor India, Merrill Lynch, and SSKI Securities. His previous assignments was as a chief economist, AMRO Bank. He has advised the Planning Commission, the RBI, the Finance Minister, and the Prime Minister. He has periodically been a member of a group consulted by RBI Governor on monetary policy. He is a member of the bank's Apex Asset Liability Committee. He has also been in a number of key consultative committees of the Indian Banks Association, CII, ASSOCHAM, and the Bombay Chamber of Commerce. He is a regular commentator on television rights, a regular column for Economic Times, a major business daily, and is a regular speaker at finance and economics conferences both in India and abroad. He was educated at the Delhi School of Economics and the University of Maryland, USA. He publishes regularly in academic and semi-academic journals, and his paper on financial inclusion in India 2015 was rated the most widely read paper on the Social Science Research Network, SSRN. On behalf of the whole organizing committee of Ramanujan College, University of Delhi, I would like to invite Abhik Barua sir to deliver his lecture.
Right. I hope I'm audible clearly.
Yes, you also audible.
Right. Thank you, Saurav, and thanks to everyone else at Ramanujan College for inviting me for this. These are very difficult times, and I am speaking to you at a time when I'm sure a lot of you are, coping with very serious trauma in the family because of the infection. And I hope that all of you, stay safe or recover. It's difficult to pay too much attention to monetary policy principles in the middle of this kind of a crisis, but I will do my best to try and convince you that there is a way out of it, at least on the economic front. And let me just sort of begin by talking a little about what the challenge really is when we are looking at the pandemic and the post-pandemic world, as the title of the lecture refers to. So what is the problem? The problem is that because of the pandemic, which set in roughly around March last year, that's in 2020, there was a contraction in GDP growth and a contraction consequently in GDP. So we are at the end of the last fiscal year, that is right at the end of March 2021, we were significantly below the level at which we were at in March 2020. So we kind of fallen in terms of GDP. The first challenge that we have in terms of economic policy and how to get things back on track is to at least get the GDP output level or the GDP level back to what it was before the pandemic, so the March 2020 level. And given even some of the more optimistic forecasts of growth this year, say about 10% real growth, which would translate roughly to 14 and a half, 15% nominal GDP growth, you will sort of kind of get to that pre-pandemic output level, which was the end of 1920 fiscal output level, only in the first quarter of 22. So there is a lot of catching up to do. The other thing which the IMF, for instance, talks about, and this is a metric that researchers at the IMF have been, showing us and highlighting to us, is that, well, if you look at the red line in the chart on your right hand side, this was the growth path before the pandemic hit us. So this is, if nothing had happened, if COVID hadn't happened, this is the kind of path that we would be on, and we've sort of indexed it to 100 just to give you an idea of where we would be. As you can see in the last year, we strayed off that. Now, even if we start picking up in terms of growth and we hit a level of growth which is comfortable, in terms of the GDP level, there will still be a large gap between the trend level that prevailed before the pandemic and what is likely to happen with the economic impact of the pandemic. So the idea then is to squeeze the gap between these two lines and try and take the blue line up as much as possible to the red line. As you can see, that the gap is large for India, and we need every possible effort that can be made in order to get to this point. Now, what kind of efforts can be made, and what is the thinking on this? Broadly, I think we've arrived at a consensus that fiscal policy is very critical, and perhaps the lead has to be taken by fiscal policy. But what economists across the board are saying, that fiscal policy alone will not be able to do it. We need a coordinated effort between fiscal and monetary policy. And the monetary policy is really the amalgam of two sets of institutions. One is the central bank of the country, which is the RBI in our case, and of course the entire banking and financial system. So monetary policy is a broad umbrella term which looks at policies that affect the financial system, particularly banks, but also other markets like the bond market and so forth. So one of the things, for those of you who have read monetary policy formally, one of the critical challenges that came up during the global financial crisis of 2008 was, okay, you can drop your interest rates to very low levels, and that if you have a shock to the system, if your aggregate demand or aggregate output is going down, then the obvious first response would be to lower interest rates. This is typical Phillips curve. This is typical monetary policy as we have learned it in our undergraduate textbooks. But then the question is, you keep dropping in, and it drops either to zero or an extremely low level below which it is not feasible to drop it further. For developed economies like the US or Europe, it's the zero interest rate level. In the case of India, perhaps 2.5%, 3% is the minimum we can bring it down to, and I'll sort of get to why that is the case. But let's talk about the zero situation. What do you do when you reach what researchers in monetary economics call the zero bound? So if you are interested, a lot of this work has been done by the former Princeton professor and then chairman of the US Federal Reserve, Professor Ben Bernanke, and he said that, look, what we need to do is forget about rates. We've already brought it down to zero. But what more can we do? And what can be done is increase the supply of money. And how do you do it? You do it really by increasing reserve money, and then you hope that the money multiplier will play on it and lead to large monetary expansion. How does one create reserve money? The central bank buys bonds, predominantly government bonds, but it could buy other things as well. And it buys the bonds and releases money into the system. This is reserve money creation. Then you have the multiplier process taking over. If you look at the more popular reportage on this, we keep hearing in the context of the RBI, Indian banks, durable liquidity, deficit monetization, etc. This kind of creation of reserve money, the RBI calls durable liquidity creation, because it's not just a short-term infusion of money. It's durable liquidity creation. And this is also indirect monetization of fiscal deficit. We'll come to direct monetization a little later. The other thing it can, of course, do is to cut the reserve requirements in the economy. As you know, banks have to hold, to put it very crudely, cash at the central bank, all the time. And if you cut the required amount of cash as a percentage of your deposits, it also leads to an infusion of durable liquidity. This is what is. These are some of the ways in which you are trying to counter through monetary tools the impact of pandemic, which is an large adverse shock to aggregate demand and aggregate output. Then you can also have various things, open special liquidity windows for sectors or institutions that are involved in lending to sectors. In India, for instance, NABARD is a very big lender to the agricultural sector. And so you say that, look, I, as the RBI, will give you money to lend on to farmers, other agricultural entities, and you go and lend. One of the interesting things that we can't do, but has been done in Europe, for instance, is you must have heard of negative interest rates. Now, what are negative interest rates? Negative interest rates are you say that, look, I have created so much liquidity for you. So the central bank tells the banks that you have created so much liquidity for you, but you're not lending. All you're doing is you are taking the money and putting it back with us, right? Which a bank can do through by increasing the amount of reserves or putting it in the reverse repo window. So if you cut the rate to negative, so in order to park money with the central bank, as a bank, you need to pay the central bank. So there is a huge disincentive in order to put your money, the durable liquidity creation, back with the central bank in the form of excess reserves and a push to lending. Then you have the issue of direct monetization of the fiscal deficit, which is an ongoing debate here. Should the RBI directly subscribe to primary bond issuances of the government? The RBI does not subscribe to primary bond issuances. So when the government comes in and does an auction, the RBI cannot, under the current framework, the legal framework, is not able to subscribe directly to these bond issuances. It does it indirectly by using the secondary market to pick up bonds. But what about direct monetization, which is the good old-fashioned notion of deficit financing, which used to go on earlier, if you remember, in the 80s and 90s. I come from a generation which grew up on this idea of deficit financing. Let the government increases deficit, the Reserve Bank will finance it. So that's one option that is yet to be explored. But given this particular pandemic, the second wave, and what it is could do to the economy, I think all these options are on the table. Another thing that I wanted to talk to you about in terms of policy options is this business of helicopter money, which a lot of people talk about. That should India now infuse helicopter money? And helicopter money is a word that Milton Friedman first started. Basically, the metaphor is of a helicopter moving around and showering dollars or rupees onto the on people, and they're taking it and buying. So there's a boost to aggregate demand. If you look at it from the ISLM perspective, I mean, it's a huge push to the LM curve, which is happening. But here, it's important to understand how it actually works. You can't really have helicopter showering notes. The RBI lends to the government. The government immediately makes large cash transfers to households, and then the RBI says, okay, as the government, you are creating too much of a debt burden for yourself. Servicing it is going to be a huge problem. So let's write it off. So that theoretically is helicopter money, but it's basically a way of putting money very quickly in the hands of people. And finally, I just wanted to emphasize the bit about managing government bond yields, which is now really driving our monetary policy initiative. That okay, you've noticed, you must have not noticed, but remember that the fiscal deficit in the budget, both for last year and this year, is spectacularly high, 6.7% for the current year, 9.5% for last year. Now, the automatic tendency, again, I would ask you to go back to either your ISLM framework or the loanable funds kind of models that you're familiar with. So there is a huge demand for loans. Interest rates start picking up. So as interest rates start picking up, there is either crowding out of private investment. You might argue that, look, in the case of a pandemic, which private investor is really going to invest? So it's actually crowding in, fine. But the problem is that as interest rates go up, as you borrow as government borrow from the markets in order to finance your deficit, interest rates go up, and then you're stuck with a permanent fiscal problem, because you have to pay these interest charges not just this year, but for the entire tenor of the loans. And loans can go all the way up to 30 years. So you're putting a permanent fiscal, you're increasing your fiscal burden on a permanent basis. I wanted to spend a little time on this just to give you the various options involved. And I'm sure as going forward, you will see some of these options being used again. The other thing that I need to familiarize you with is, okay, the other thing that is very sort of widely discussed, the RBI is doing so much, but loan growth is still very tepid, or interest rates are not going down. There is no transmission. Transmission could either be to interest rates or to credit demand. And in a situation of a pandemic, when companies have been hit really hard, there is loans are given on the basis of collateral. The companies might not have enough collateral to offer. So here we see another direct interplay of fiscal and monetary policy. So what does the government do? The government says, okay, you as banks, are obviously very worried about your loans going bad if you lend in a pandemic situation. I will guarantee these loans, right? Which means that if a company defaults on this, I will pay you the money. So this was experimented with for the first time in the last budget, the loan guarantee scheme, the ECLGS for the small and medium sectors. You can have part guaranteed loan, and I don't want to get into the technicalities of this, but here again, the government plays a role. So I'm really talking about when I refer to the government, I refer to it as the fiscal authority. So the fiscal authority, as I said, in a coordinated effort, is interfacing with the monetary authority in order to also, borrow at lower costs, and also trying and pushing credit into the system. And finally, you have a situation where if there is a huge shock to the economy, people are simply not in a position to pay their all kinds of charges on debt, your EMIs, etc. All of you, who have taken either a housing loan or a car loan know how difficult it is when there is an income shock. So you put a moratorium on this. This is regulatory forbearance. Now, just to as I said, that increasing money supply or reserve money is the way to go forward if your interest rates are already very low and things are not working. This is just to give you an idea. On the left hand side, we are looking at the um, performance of central banks. Just one second, I just need to see. Okay. Sorry. Uh, this is the Bank of Japan, the European Central Bank, and the US Central Bank. This is how their balance sheets have expanded. The balance sheet expansion is the balance sheet size, very crudely put, is simply the amount of money that the central bank is creating. So you can think of it as reserve money. So in last time's monetary policy here, also the governor said that we're committing our balance sheet to creating liquidity conditions that are favorable to credit growth. So you see how the central banks across the world have been increasing their balance sheet size. And this, if you must be familiar with this expansion of balance sheet is called quantitative easing. This is the famous QE or quantitative easing, which is going on. Similarly, we've seen the RBI trying to to follow the same tack, increase reserve money, and also achieve M3 growth or money supply growth as a process. Uh, it is curious, and I'm sure this is a good undergraduate question. If you just put this chart and say what is going on, why is reserve money outstripping M3 growth? The answer lies in the money multiplier. The money multiplier, typically in the case of a huge slowdown, is slow. So credit demand is limited. So credit is not being created adequately, and consequently, the reserve money translation into broad money, so base money translation into broad money, tends to suffer because the multiplier is low. So this is a good money multiplier question that you might want to ask your students. So I'm not going to go through all the details of this, and I'm sure these slides will be available to you. So I described the toolbox that every central bank has that it can use in order to counter a large shock like a pandemic. It will have to continue to use this even if the pandemic were to recede, because the economy is not going to recover immediately after the pandemic. So even in a pandemic world and a post-pandemic world, these are broadly the tools that the central bank has. And these are some of the tools that it has already used. So I spoke about liquidity creation, the QE business, easing financial stress, which is moratorium, and then you have debt management, which is managing yields. So broadly, this gives you an idea. In the Indian case, what has been done. Let me tell you what the RBI is doing currently. So I think after some amount of dithering and some questions regarding whether fiscal stimulus and fiscal support was critical to get out of the pandemic, and questions being asked about the debt ratio, whether it will be sustainable, what will happen to credit ratings by international agencies for India, and so forth. I think the broad acceptance that fiscal policy will have to drive growth was accepted in the budget. And I suspect with the second wave, we will have to have more fiscal policy measures, both for relief. So take the case of something like the hotel and restaurant sector or the airline sector, which is completely decimated. So they need support. And this is something we're being seeing across economies. Households also need support, again, being seen across economies. Particularly for India, it becomes a big challenge because we have such a large informal sector where job losses are very quick. So fiscal policy has been accepted and will continue to do the heavy lifting, as we say. But what is the RBI's focus now? The RBI is really, and one thing you must understand in that in monetary policy, everything is kind of interrelated. Doing one thing achieves another objective simultaneously. So the RBI's focus, as we understand it in the banking world, and I think in the part also in the policy academic space, is that the RBI is now focusing on managing and keeping government bond yields down, so that there are two effects. One is that the government doesn't get into a huge fiscal trap going forward, because you remember, as I said, you are issuing bonds of long maturities, and if you're getting into or borrowing it at a high cost, then you're stuck with a huge debt servicing problem. So the RBI is trying to minimize that problem. And how does it keep, so that is the RBI's central objective. Now, how does it do it? It does it simply by infusing. Uh, what intermediate step is there? So if you want to keep the yield on a bond low, if you remember that there is an inverse relationship between bond prices and yields. So what you need to do is to push up, to create demand for the bond, so the bond price moves up. Banks are saying that, look, we are not that keen to buy these bonds and create this necessary demand because we think there are a lot of problems around the horizon. So the RBI comes in and says that, okay, not in the primary market, but in the secondary market, I will buy bonds. So automatically, as they buy bonds, the demand for bonds goes up, prices go up, yields go down. So it's yield management. But you will also notice, as I said, things are interlinked. By buying bonds, it is also simultaneously, almost as a sort of a side effect, releasing a lot of liquidity into the system. Because think of the bond buying action. What does the RBI do in order to buy bonds? The RBI does not have any income of its own, but it has this huge advantage that it can actually create money in the system. So it is effectively buying bonds, paying for it through rupees, and creating liquidity in the system. So we are looking at a situation where we are very much like other central banks. Perhaps the initial motivation is slightly different, but we are going down the path, and we will continue to go down this path even in a post-pandemic scenario, where we keep the liquidity in the in the system high and keep government bond yields down. And government bond yields are a benchmark yield for the system as a whole. So all yields and interest rates are likely to be kept under control. What are the risks of monetary expansion? So this is, again, textbook, almost textbook undergraduate economics. Of course, high goods and services inflation. But if you think about something like the Phillips curve, or if you are familiar with the output gap literature, some of the new Keynesian models, etc., if the output gap is negative, there's not enough demand in the system, you could argue, and this is what the central bank is arguing, despite inflation being really high, that, look, there is a negative output gap. So whatever inflationary pressures that are coming are likely to be supply driven and transient. There isn't enough demand in the system to create a permanent increase in inflation. We could debate that, we could argue that, but this is what the central bank's response is. The other problem, of course, which you are, for those of you who invest in mutual funds and stock markets, are witnessing every day, is the disconnection between what is happening on the ground. The pandemic is happening. There are lives being lost. Infections are reaching, record highs, and yet the stock market doesn't seem to be crashing. Why is that? Because there is simply so much liquidity in the system, creating this kind of what the former US Fed chairman called irrational exuberance. The risk with irrational exuberance is simply the fact that it is irrational. At some point, your expectations about the real economy and the profitability of companies could change. So you could have a major crash in the various asset markets, including the stock market. The other problem is, if you want to wind back this super accommodative monetary policy, it's a problem. We had the so-called taper tantrum in 2013 when there was the first sign of the US Fed not doing as much bond buying as it was doing earlier in response to the 2008 financial crisis. We are again in a situation where any attempt, either by the US Fed or in our case by the RBI, to cut down liquidity from the very, very high levels that it is prevailing at will lead to major problems in interest rates and bond yields. So you're kind of stuck. You as a central bank, you are almost being held hostage by the bond markets and the financial markets to keep your money machines going. As I said, inflation is a risk. We are looking at this risk very, very closely. Inflation has been rising. If you look at it from a consumer price inflation perspective, that has remained very high. Some people would argue, though, maybe it's because of transient things like food and fuel, which shouldn't actually be looked at. But even if you take core inflation, which takes this out, that is very high. And the other thing that has started happening is that wholesale price inflation, which gives you an idea of factory gate inflation, which is independent of the distribution of the supply chains between the factory gate and the distribution retail point. So between the Hindustan Lever factory and the Kirana store or the supermarket where you buy your biscuit, it's independent of that. So it gives you the factory gate price. Now, earlier the factory gate price was low. So everyone was saying that this is because of pandemic-related distribution disruptions, supply disruptions. But wholesale price has also gone up. One of the reasons, again, is that there is so much liquidity in the system, in the global system, that things like steel prices, aluminum prices, commodities are moving up, and those are automatically giving a push to wholesale price inflation here. So what does the RBI do? It's caught really in a dilemma. It's between the devil and the deep blue sea, as we put it. But at this stage, and I wish we had a sort of a more interactive thing where I could do a poll, I think most of you would agree that growth gets a priority, and inflation will have to we'll have to make token gestures towards inflation, maybe not cut the repo rate further, but we'll have to keep growth moving. So some of it, you might ask, so what has happened with all this? You're talking about credit push, etc. And yet you haven't been able to cross the 6% mark for credit growth in quite some time. And now it has come down all the way to 5.5%. Is this how? So is monetary policy working? What more can you do? Uh, I would say that getting 5.5% when it is coming on the back of an economy that has contracted by 7.5% isn't too bad. In fact, credit growth has broken its usual relationship with GDP growth and grown much faster than nominal GDP growth. Because if just let me remind you of the fact that last fiscal year, GDP growth contracted by 7.5%. Credit growth was in the positive territory. What do we do to make this credit growth move up faster? Unfortunately, the answer is I have showed you the entire toolkit that is available with the central bank, the RBI. It's got to be more of the same. And banks, hopefully, as the economy starts picking up, will start lending more and supporting the growth. But there is precious little that can be done beyond this. And of course, banks are still worried about non-performing loan risks. So if you look at the chart in the bottom right-hand corner, these are the bad loan ratios, the gross non-performing assets in the bank, in banks, and that is pretty high. It's about 7.5% for the system as a whole. But if you look at the public sector banks, the first set of columns, it's at around 10%. And the RBI says that it could go up. The overall bad loan to total loan ratio could be as high as 13.5% after the pandemic. So, of course, there is some reluctance of banks to lend. And despite all the liquidity, despite the various tricks in the RBI's book that I spoke to you about, there is still a reluctance to lend. Perhaps the only way to do it, to counter that, is to continue with some form of guarantees, or the other to sectors where you want the credit to flow. But unless there is an overall major recovery in the economy, credit growth is likely to remain sluggish despite the monetary authorities' best efforts. If fiscal policy starts pushing demand up, and it starts with infrastructure, and then other sectors starts participating, credit growth will pick up. The RBI is ensuring that the situation is such that you are not starved of either liquidity or credit. The final thing that you can do, and which was done, was this business. So we spoke a little bit about the the bad loan ratio, and the thing that was again introduced in the budget, and this is a very important innovation for the banking system, is the bad bank idea, which is here called an AMC ARC. So what is a bad bank? So as I said, we have a huge problem of bad loans in the system. And one of the things that holds banks from lending, despite the various efforts, as I described earlier, by the RBI in order to lower yields, in order to push liquidity into the system, it is not translating into credit, partially because of the fact that there is so much bad loans in the system. Again, I'd like you to take a look at the GNPA ratios. These are high. Just 10 years or 7 or 8 years ago, these numbers would have been in the 2s and 3s. 10% of loans are bad loans, likely to go up to 13.5%. Major cause for concern. But there is a stock of bad loans which is holding it back. So one of the efforts that was made in the budget, and this is something that bankers had been asking for a fairly long time, is, can we take the bad loans off the books or off the balance sheets of some of these highly stressed banks who have a large proportion of bad loans, and can we give them some relief? And and the argument was that in many other countries that have faced a crisis, this has been done very effectively. And a particular reference was made both to the global great financial crisis of 2008 and the Asian financial crisis of 1997. So, what happens Uh, here? This bad bank has two functions. One is the function of buying bad loans and then restructuring the loans. So you make the underlying company or individual who's taken the loan more viable through a series of restructuring. This can be change in ownership, change in management practices. It can be an entire overhaul of the organizational structure. And then that is the purchase and reconstruction side of the problem. And then what you need to do is then sell it in the market. And there is a very large market for people who buy bad loans. And what is the motivation? Because they think that if I buy this bad loans, I'm getting something which is at the moment a bad loan. It is not being, I'm not getting any money out of it, but I can buy it from this bad bank really cheap. So I have a claim over something that might come my way. And if I believe that the reconstruction activity within the bad bank is actually going to increase the profitability and hence the credit worthiness of the underlying institutions, then at some point the loan will start to actually be functional. It won't be bad anymore. And there's a whole range of both particularly international investors who are interested in buying bad loans. So if one model that I think has been used very actively in structuring the Indian bad bank has been the Korea bad bank model, which was, if, for those of you who remember the Asian financial crisis, which happened in 1997. Korea was very badly affected by it. Banks had very large bad loans as a result again of the shock. But Korea went ahead, created a bad bank, and it went very aggressively towards creating a market. And it found international investors and domestic investors who were interested in buying these bad loans. Because bad loans are not bad forever. If you have the right kind of restructuring, if you have the right kind of support, the bad loan can turn good. So that is the bet that you're taking as an investor. And Korea managed to do an excellent job with this. This has partly been a model that India has followed. Other countries, Malaysia's Danaharta bad bank experiment was extremely successful. Bad banks comes in all shapes and sizes. You can have one large state-owned bad bank, which is you can have some private ownership there, which is the model that the path that India is walking down. It's largely government-driven, but with private participation there. Or you can have a small a bank which has a bad bank within itself. So it takes all its bad loans, non-performing loans, impaired loans. These are the various words that you will come across when you come across the bad loan literature. These it can put in another bank, another entity which called something else. Citibank, for instance, has something called City Financial, and that is one of the most successful stories of a bank's own bad bank, managing to dispose of all the bad assets and actually making a profit at the end. So a bad bank need not be a very large entity. You can have multiple bad banks attached to different banks or groups of banks. And perhaps once um, uh, the first bad bank, which is the state bank owned bank that I was talking about in India, is established, we'll also start seeing multiple more bad banks, maybe smaller ones coming in. Uh, we must go out. And this is not going to happen without creating a market for bad loans. And uh, there will be a lot of controversy about the purchase price. As you can see, when you are looking at the price of something that is obviously bad, it is very controversial. That what should I pick this up at? What is it? What is the fair price? So there is likely to be a lot of controversy, but I think this is a very good idea that would perhaps ease some of the stress that banks face. And in the post-pandemic scenario, so we are looking at, let's look at so I'm coming close to the end of my lecture. So in the post-pandemic scenario, what is happening? Uh, you have fiscal policy, which is driving demand. You have monetary policy, which is kind of supporting the demand by pumping in a lot of money into the system. As I said, balance sheet expansion by central banks is driving this. This is leading to low interest rates. But despite that, credit demand might not be picking up, but you have to keep hitting away at the problem. And once fiscal policy starts to pay off in terms of improved aggregate demand, some credit demand will come back to the system, and it will go up from, say, 5% to 7% to 8% 10%. And the central bank is creating, the RBI is creating a scenario where these increase in loans will not, because there is so much money or liquidity in the system, will not mean an immediate increase in interest rates or yields. There could be some increase, but not an increase which is going to just completely stop the process from going through, and credit will be available at relatively low cost. Uh, as I mentioned, monetary expansion has its risks. Uh, it has its risks in terms of goods and services inflation. It has its risks in terms of asset inflation. And, economists do not ever have definitive answers that this is what should be done, this is what should be ignored. And if the economy stabilizes, there would be these questions about whether we should have ignored the inflation risks, whether we should have ignored the rational exuberance in the asset markets. But my sense at this stage is that we have to prioritize things. And clearly, as I'm presumably speaking to people who have seen how bad the pandemic is and can perhaps imagine what the economic impact of the pandemic in terms of employment, aggregate demand, etc. is. So I would think that let us keep inflation for a while on the back burner in terms of policy imperatives and focus on growth. Maybe inflation will be high. Core inflation is high. That is something that is a problem area. Things like services prices like education, health, transport, all this is going up. We must recognize that the global economy is now beginning to recover, and there is a lot of money around, which again has been this monetary policy response to their pandemic shock. And that means that commodity prices, etc., we see oil very clearly, but I mean, there are a whole bunch of commodities, steel, copper, other metals, etc. Semiconductors have all gone up. That is exerting a cost push pressure. So do not be surprised if you see inflation over 5%, and the RBI not doing anything specific about it. As I said, it is a question of priorities. Um, the RBI, as I sort of told you about the various options available at a sort of a more theoretical level, and also illustrated to you that the RBI has pretty much explored and used all the options. Um, in terms of one other thing, a very critical thing in the Indian context, that might be holding banks back from lending is the pile of bad loans they're already sitting on. And that itself is a constraint to do additional lending. But hopefully, the bad bank structure, which is an innovation in our case, will address some of these problems, and banks will be in a better, freer position to take advantage of this expansionary monetary situation in order to lend and lend at low rates. So that's I would draw my lecture to a close there. And this material is hopefully will be circulated to you, and I'm available to, and I'll share this with Saurabh. I'll be available on my email to take queries, etc., from you if you have any.
Thank you very much, sir. And we will have some queries from the participants.
Sure.
We'll be raising over here to explain about these one. The first question is from the Kashinaji is asking about was the central government's decision to withdraw rupees 170,000 crore from the Reserve Bank of India during the pandemic period is justified?
Are you referring, if you're referring to the dividends, it is justified because basically dividends are an income for the government, and the more the income from the government, the smaller the fiscal deficit. You must realize that there is the RBI has a monetary money creating role. It is also a part of government, like any public sector entity is, which offers dividends to the government. And we can, discuss the dividends issue later because it's a complex thing. But this money, if you're referring to dividends, yes, it was justified. It has nothing to do with monetary expansion as such.
The next question is, sir, सेंट्रल गवर्नमेंट का आरबीआई की पॉलिसी में होने वाला इंटरफेयर आवश्यक है क्या, जिससे आरबीआई जैसे ऑटोनोमस बॉडी कमजोर बनती जा रही है क्या?
मुझे नहीं लग रहा है कि हाँ, ये तो एक कंट्रोवर्सी हुआ था, और हाँ, आरबीआई की इंडिपेंडेंस की जरूरत है। लेकिन अभी मुझे मानना है कि अभी जब ये पैंडेमिक का असर इकोनॉमी में इतना ज्यादा दिख रहा है कि दो अगर कोऑर्डिनेट करके करे, फिस्कल पॉलिसी भी पैंडेमिक को फाइट करने की कोशिश करे और मॉनेटरी पॉलिसी को सपोर्ट दे, इसमें सेंट्रल बैंक पे में सेंट्रल गवर्नमेंट का इन्फ्लुएंस का एक प्रॉब्लम देखना मुझे मुझे सही नहीं लगता है। मुझे लग रहा है कि अभी अगर हम जो ये जो सिचुएशन में है, इससे अगर बाहर निकालना है, तो फिर कोऑर्डिनेशन हमें रखना पड़ेगा बिटवीन फिस्कल एंड मॉनेटरी पॉलिसी, और वो हर जगह ऐसा हो रहा है। लेकिन एज अ ब्रॉडर पॉइंट आपने एक बहुत ही खास मुद्दा उठाया कि हाँ, सेंट्रल बैंक कभी भी एक सेंट्रल गवर्नमेंट का एक छोटा सा एजेंसी ना बन जाए, वो कोशिश हमें जारी रखना है। इसका कंट्रोवर्सी पहले हुए थे कैपिटल ट्रांसफर के मामले में, इन्फ्लेशन के मामले में। an independent central bank is important, लेकिन any coordination between the central bank and the central government should not be seen जैसे कि मैं कह रहा हूं कि अभी सेंट्रल कोऑर्डिनेशन का जरूरत है, ये कोऑर्डिनेशन इंटरफेरेंस नहीं है। ये मुझे ये लिमिटेड पॉइंट मेरा है।
So the next question is, what is rationale behind formation of MPC?
देखिए, जो द रैशनल बिहाइंड दिस इज basically most central banks which have succeeded in bringing inflation down have followed these committee structure, and this committee structure brings in more and especially if you have an inflation target, which we have the flexible inflation targeting model, the committee structure brings into play a lot of issues that need to be discussed, which often does not happen if it's done unilaterally only by the RBI governor. Also by publishing the minutes of the discussion, etc., things become much more transparent for the markets, and it's good for market efficiency. And in almost all cases where MPCs have been introduced, there has been a significant reduction over the medium term in inflation. So put all this together, so we've decided to move to an established institutional structure of conducting monetary policy. I am not saying that I entirely support the idea of formation of MPC in India, but I'm saying that this is the rationale behind it. I think we have to assess how much the MPC has been able to do in terms of bringing inflation under control. That is a much bigger debate. I wish I had another 1 hour and we could all sit and debate that.
Sir, one more question from Pranav Anand. How to increase institutional agricultural credit in positive ways to small and marginal farmers?
So there are various. So one is the of course the MFI route, the microfinance institutions, self-help groups, etc. That has taken off in a big way to help small farmer families. Might not be directly for farming activities, but certainly in order to buttress family incomes. MFI is one. NABARD plays a very big role in the agricultural credit markets, and there is an effort to increase agricultural lending by NABARD. You must remember that banks also have a major portion, 12% for domestic banks, under the priority sector requirements to be lent to the agricultural sector. What we are finding as a bank is that there are actually, even among small and marginal farmers, lending can be profitable, it can be risk free. So I think the challenge is not just from the credit side, right? If you do not de-risk the farmer, lending credit to the small and marginal farmer will always be a challenge. Even if NABARD is there, even if the public sector banks and private sector banks are priority sector targets. So I think de-risking the farmers, there can be crop diversification, small level agricultural insurance, which is now being available, direct benefit transfer for critical subsidies, etc. Just make small and marginal farming a little more viable, and it enables banks and institutions like NABARD to extend more loans without always fretting or worrying about bad loans developing.
Sir, one more question. I think two of the questions are almost interrelated to each other. See, how
Mhm.
much effective last year monetary policy in Indian economy and recent inflation in India linked from where?
Look, I spoke about this, that if you look at it in terms of credit growth, etc., you might think it hasn't been that effective. But just remember this: the economy has contracted by 7.5%, yet credit growth was about 6%. So monetary policy has worked to a degree. You have to look at it in relative terms. And today it has created a situation where fiscal policy can go ahead and provide aggregate demand support, create infrastructure, do other things, or even provide fiscal support, the Garib Kalyan Yojana, without worrying about interest rates moving up spectacularly. So that is my answer to the first part of the question. The second answer is that inflation is coming both from the services sector. We have chronic bottlenecks, and all of you are aware of this, in sectors like education. Health has become a very major problem area. There's been escalation there. On the goods part, we have, as I said, escalation in commodity prices, oil, steel, other commodities, chemicals, and that is a cost push inflation pressure, which is pushing inflation domestically up.
Sir, one more question is here. Could you please brief more on negative interest rate and its scope for implementing in Indian scenario?
In the Indian scenario, we really don't have a scope for the RBI Act and the legal framework will have to be changed. Now, but theoretically, how is this done? Banks in most countries have the facility of parking excess money with the central bank. Here we do it through the reverse repo window. You have things, other windows available in the European central banks, in the Fed, etc. So, suppose a bank is sitting on a lot of liquidity and it's not lending. So, what can it do? It has to earn some return on it. So, if it is very, very risk averse, it puts it back with the central bank, either at the reverse repo window or whichever window is available to it. So then, policymakers, the government says there's so much liquidity being created, yes, yet there is no credit push. So you literally push the bank away from putting the money in reverse repo by bringing the reverse repo down to a negative level, which means that if you were to park money with the RBI, you would have to pay the RBI some money. So once that is not available to you are sitting on a lot of liquidity, you will think of other channels of lending. That is the logic. As I said, in India, it cannot be done. I just use the RBI as a hypothetical example. In Europe, it is being done. Any excess reserves of banks, if you put it with the central bank, you will get a negative rate of return. So that sort of pushes you to consider other avenues, particularly the credit avenue for lending.
Sir, which measures, monetary or fiscal, is more effective to control post-COVID inflation in India?
Well, I think a bit of both, because both fiscal expansion and monetary expansion would have um, contributed to the inflation buildup. So both will have to be used to curtail inflation. I think the RBI will have to normalize monetary policy and money supply level much below the level at which it is going now. But fiscal policy will have to work very effectively in supply management in order to make supply chains more efficient and repair broken supply chains. So let me take an example which is happening now. Because of this oxygen crisis, I think a lot of supply chains will have been severely disrupted, right? Because these supply chains are now being used to transport oxygen, which is the need of the hour. No one can argue with that. But this is a large disruption of the national supply chain, which particularly affects small and medium enterprises. Now, at some point, once the pandemic is over or it sort of reaches a more control level, some effort will have to be made in order to rebuild the supply chains. For that, government money is needed, and that is fiscal effort. So you'll have to do a combination of fisc and monetary uh, efforts to bring inflation down.
So I think it's a very burning issue and relatable in this pandemic situation. So very people are very much eager to ask some questions. So, so the next question is from Anjuji. If the bad bank is helping the underlying institution who has borrowed money to repay the debt through restructuring, why should it sell the bad loans in the market? Can make the idea clearer, sir?
No, the bad bank is basically an intermediary, right? It is buying the loans from a stressed bank, making these loans more attractive by working with the borrowing institution. So the once you've taken it off the initial bank, the initial bank is in a freer position. You agree? So this person has, so the bad bank has bought 100 rupee loan at say 60 rupees because it's a bad loan. Either you are getting zero or interest, etc. You bought it at 60 rupees or 40 rupees, etc. Now you want to make as much of a return as possible on that. So you work with the company which took this loan uh, which resulted in a bad loan. You either work with the company, change the ownership, do all kinds of things, which is what the work of a resolution professional is. You change the organizational structure. The company starts becoming viable, right? Once the company starts becoming viable, once you have a market for bad loans, that 40 rupee loan is now, and these are all made into securities, that 40 rupee loan is becomes 80 rupees. So you have a neat 40 rupee margin on that. And that is the other side of the picture, the asset sale side of the picture. So on the one hand, you bought it at 40, you've restructured, sold it at 80. So that is how the bad bank is expected to work.
Sir, the next question is, what is the effect of deficit financing on monetary structure in this pandemic?
Well, monetary structure, I really don't know what do you mean by monetary structure, but I would guess that deficit financing is direct monetization of the government's deficit. Let me, as an economist, as someone who works in monetary policy and monetary economics, despite whatever that there is a lot of reservation about deficit financing, and it goes back to one of the earlier questions that I answered about central bank independence, etc. That if you central banks buy government debt directly, then it reduces the central bank's independence. All that is fine. But in this pandemic, when people are dying, when industries are being affected so badly, I think there is room for deficit financing, which simply means, in the way that I mean it, is the RBI buying the government's loans in the primary market. So the government, in order to finance fiscal deficit, is selling bonds. If the RBI buys bonds directly in the primary auction, that is known as deficit financing. Right? I don't see a problem with that, quite honestly. And nor should it be confused with reduced independence of the central bank. This is the need of the hour.
Sir, the next question is, what is your opinion, sir, about bank privatization issue?
My opinion, I don't think it is a silver bullet, and I do not. Although I work for the largest private bank in the country and the second largest bank in the country, HDFC Bank, I think the public sector in many ways is just as efficient as the private sector. There are some problems there. I but what appears to be the case is that there is a lot of some decisions. Let me put it as diplomatically as possible. For the public sector, a lot of business decisions are not based on sound principles of business. There are other influences at work. If that cannot be resolved without privatizing, then go ahead and privatize. But I think it is this. There is a myth or a perception among a lot of people that the public sector banks are fundamentally inefficient vis-a-vis the private sector banks. If you look at a number of studies, I can refer you to Rakesh Mohan's studies on public sector banks have actually on a lot of efficiency parameters. We caught up with private sector banks and have functioned well. If their fundamental decision-making process by virtue of their ownership is being affected by non-business considerations, then perhaps privatization is the only alternative.
Sir, we have 2 to 3 more questions. If you allow us, so we can.
Sure.
What is your opinion about RBI monetary policy under this pandemic situation? Will credit creation will boost the economy under this bad situation?
Look, as I said, that RBI has done its best. Credit creation will remain tepid, but without the RBI's efforts, it would have remained even more tepid. The RBI has done a fantastic job. It is continuing to do it, but the real economy and the monetary economy are, there is an interplay. Once the real economy starts picking up, and I think some of that will have to come from fiscal policy impulses. Once that starts picking up, then you will see a demand for credit, and the RBI is ensuring that there is enough money available for that credit demand to be serviced.
So the next question is, if inflation rate is increasing and as you suggested, mild inflation is necessary for reviving the economy, wouldn't it is going to hammer the purchasing power of migrant workers?
Um, Yes, these are very, very complex trade-offs. I would suggest that I would make a very strong case although I realize that very few migrant workers have Jan Dhan accounts, but migrant workers need. I was looking at a survey done by Ashok Gulati and one of his colleagues that migrant workers' incomes go down by a fourth once they return to the. I honestly think we need to have a very solid insurance scheme for job and work insurance, social security scheme for migrant workers. I think they deserve it. We'll. It is true that inflation will affect them, and I completely appreciate where you're coming from. I think the time has now come. We cannot hope to design this 2 years down the road. We'll have to do something now. And I think migrant workers, my heart goes out to them, and we need fiscal support in the form of cash transfers and the creation of a long-term job insurance scheme for the migrant workers.
Sir, one more question is there. What is the rationale of privatization of commercial banks 50 years after nationalization? Where we went wrong, and is there a room for further nationalization in future? This is the last
I don't think, as I said, I think I answered the privatization question, diplomatically without taking, using words. I mean, there is a lot of decisions have been influenced by non-business considerations. And if you think about nationalization under Mrs. Gandhi, and here I'm going into a little bit of history and political economy, it was very much a part of the Garibi Hatao kind of program that was initiated, right? But banks should certainly be. Financial inclusion is very, very, very critical, and I am all for financial inclusion, and our bank has a huge financial inclusion initiative. But if financial inclusion is done on a completely unviable basis, right, you're creating loan melas. You don't have any control. You have no idea who you're lending to. And this is not just in India. This happened in the US. This led to the crisis in 2008. You have no idea who you're lending to, but you're giving a loan. And if that is happening through public sector banks, then nationalization is a problem. And maybe privatization is the only answer to it if you can't find a solution. But I think purely on efficiency and other grounds, on I don't think the public sector is fundamentally inferior to that. There are problems of scale and size. Yes, we have very small public sector banks which need to be merged with other banks, and creating scale is critical. But that's a different story. But unfortunately, a lot of the public sector banks have been influenced to take decisions which are not in their interest. And consequently, they've also become very afraid, because then you also have the CVC, the vigilance. So if privatization is the only way to get past this, so be it.
Sir, one more question added recently. How interest on a small savings can be kept as it is? For example, Sky, EPF, NPS, etc.
Look, we have taken a decision in order to link it to underlying so benchmark rates. So if government bond yields go down, that should also go down simultaneously, because with government bond yields going down, every rate's also go down. But I think we'll have to ask a very serious question about how much Indian households deserve in the form of a real return, or the real return on their savings, the real interest rates, R minus inflation. And so I think that the today we can tolerate a little bit of inflation, but ultimately we will have to get into a situation where inflation management and bringing it down to a lower level on a permanent basis is really the solution, rather than keeping small savings rates artificially high. But in a situation where inflation rates are going up, and there was a recent controversy, if you remember, right before the Bengal elections, there was apparently a mistake made by the finance ministry, where they cut the small savings rates, and then again it was revised. I think in a situation where people are already hurting, and a lot of money is put in small savings rates, and inflation is high, you should not be bringing these rates down, because a large part of the lower middle class is exposed to. In the long term, the solution is to bring inflation down to more sustainable levels.
Sir, additionally, one informative question has been asked. Is mergers of public sector banks helpful to overcome the current pandemic situation to meet the financial requirements of the economy?
I don't see a direct link, but of clearly, a larger bank with more capital is in a much better position to do relief lending, or lending where some risks have to be taken, than a small bank which is already burdened by bad loans. ठीक है सौरभ, और है?
Saurabh, you are mute.
Yes, sir. Two more questions are there. If you are not comfortable,
No,
we
नहीं, पूछ लो.
yes, sir. Yeah. So actually, sir, this is a I think relatable issue in this pandemic. So the people are eager to ask, as I told you earlier. Sir, one more person is asking, sir, do you think that credit is provided without assessing the absorption capacity of the people, which led to bad loans?
Absolutely, you put it very well. If you, it's a very good way of, and this is not just true of India. It's happened in the US. If you don't, as I said, if you don't, if you are lending to people who are unlikely to service it. For instance, there was a lot of lending to small infrastructure companies, or infrastructure companies that came up very suddenly, led by some promoters who were very good in other areas, but they had no knowledge of infrastructure. A lot of loans were given to them. And so they did not have the capacity to absorb these loans effectively and deploy them in projects. And consequently, the bad loan crisis happened.
Thank you very much, sir. I think everything is sorted it out. Every participant had fulfilled with their queries. And on behalf of the whole organizing team, sir, I'm very much thankful to you for adding such a wonderful session in which you covered a lot of burning issues like risks of monetary expansions, permanent rise in inflation unlikely to output gap is negative, credit and deposit growth, the bad banks, GNPAs, bad loans, bad banks turns to gold if you have a good restructuring in the economy. Private participation in this sector is very much crucial in the economy. And the lemons problem and the solution to the priorities of RBI, if the priorities will be there, obviously we can handle the greater achieving goals of the economy. So I'm sure, sir, with me, that hope all the participants have gained a lot from this lecture and benefited to think about monetary policy challenges in recent pandemic situation. This lecture surely imbibed us to be more researchable and academically enhanced. And for now, sir, we are very much thankful and thank you very much, sir, for delivering us such a wonderful session and poured us with the rain of knowledge. And for winding up this session, we wish you a good health and safer days ahead, sir.
Right. Thank you very much for having me. It was a pleasure. And thank you, Saurabh. You all stay safe, please.